Excuse me.
Right then, good morning guys, welcome back to this series of taking the risk. So we're out here right at the beach, nice and early in the morning, showing my appreciations to God. We're about to go do 10 minutes in this, so with that being said, let's get it done. Alright, so how are we? You may notice something slightly different, maybe a bit closer, compared to the other clips. I've had a haircut, it's a little bit too short for my liking, but it's fine, you know, we move on. Feel free to violate me in the comments. Not in love with it, but it's what it is. Anyway, on to the video. What's going to go down in today's video, we're going to kind of review my trading journal. I'm going to go through it in relatively decent detail. We're going to pick out a select few trades. But before that, I'm going to go through a little PDF. So myself and the team came together and we worked together to design a PDF file that is essentially A to Z on the strategy. So what we look for, specific confluences, breakdown of each confluence, and I'm going to try and run through it as quick as I can, but as well explain it to you guys. So if you want to take notes, you want to take any screenshots, take notes later, you're more than welcome to do so. It's obviously been profitable for me, so some friendly Cypriot folk. They always look at me really weird when I've got the camera on. I remember the first time I met them, I was walking past like filming an intro, and they just said some waffle to me, obviously in Cypriot. I was like, English? And then they said, you camera. And I'm like, yeah, I camera. So with that being said, I know do you know what? I was watching back, I always say that. So with that being said, who do I think I am? God, this trim is... Okay, so before we get into the actual trade breakdowns, I wanted to go through this PDF that myself and the team created together, and it's designed to essentially show you exact confluences that we look for in order to frame up for a trade. This is available to all members within the Discord community, by the way, so if you wanted to join that, just check the link in the description. So in terms of the actual framework to get into a trade, we use specific areas of liquidity, more specifically session-based liquidity. So for example, London highs, London lows, Asia highs, Asia lows, etc. As a lot of liquidity lies within these areas. So just a very quick example, this is the Asia range. So the Asia range, so it's essentially the high of Asia and the low of Asia. You can see them marked out in the blue circles here. This obviously marks out where strong draws of liquidity lie, and these very commonly get swept. So we understand that price seeks liquidity, so once we know where liquidity lies, it makes it easier for us to frame up for a trade. This indicator, by the way, is completely free on TradingView. It's Asia range by Nico948. Simply type that in on indicators. Should come up, it'll look a little bit different. Mine's edited slightly. Data wicks. We also use data wicks as part of the strategy. This is another strong form of liquidity. So for example, data wicks are caused by news events such as PMI, CPI, NFP, and FOMC. On these wicks lies a lot of liquidity because obviously there's a lot of liquidity put into the market, obviously when news events happen, and these are very commonly swept. I can say 9 times out of 10, it's very easy to frame up for trades, and 9 times out of 10 we take trades using data wicks, they tend to play out. Here's a little example for you. So they can be used as targets. So very similar to the Asia high and the Asia low. It's the same principle with data wicks. You can see here that this is just an example, but you can frame up trades based on data wicks. So for example, you can look to go short to target the low, and you can also look to go long to target the high of the data wick, as these are always swept. You can go back test this, have a look for yourself. These are very useful. So the next very important confluence, especially for myself, is divergences. So if you're unfamiliar on what a divergence is, it's essentially where NQ and ES do the opposite. So there's a couple of examples on screen here. As you can see, this is an example of a bearish div. So this is NQ, formerly known as the Nasdaq, and this is ES, formerly known as the S&P 500. They move very similarly, which again you will see later on in this PDF.
But you can see here, this is what we call a divergence. You can see that NQ has made a high and ES has made a low. And because they move very similarly, when this happens, it's a strong sign of a reversal. So we can see here on the bullish div, it's essentially the same thing, just reversed. You can see here that NQ made a lower high and ES made a lower low. These can be swapped around. So for example, ES could make the lower high and NQ could make the lower low. It's still a divergence. These are very important confluences because seeing a divergence gives you a very strong indication that the market is about to reverse. So again, just to give you a bit more of an example on how we use divergences, when we see a bearish div, we use this to frame up to go short. And when we see a bullish div, we use this to frame up to go long. So just going back to the point where I said that NQ and ES move very similarly, as you can see here, this is NQ on the left and ES on the right. You see how they move similarly. They basically look identical. So when ES and NQ are not moving in sync, it's a strong indication to stay away. You can see here that NQ is continuing bullish, ES is continuing bearish. It's a strong confluence that we just don't want to be involved in price action, and we should just be patient and let the market do its thing. However, when NQ and ES are in sync, these are much more probable conditions to trade. So when they're moving in sync and we see a divergence, it's a strong confluence that the market is about to reverse. So with ES moving in sync with NQ, and then we have a divergence, this gives us more probable conditions to trade. So we use gaps specifically to frame up trades, which I'll break down very shortly. So we use gaps to get into trades, and you're going to see that very shortly when I go through the actual trade breakdown in my trade journal. But we use ES to validate our entry. So we want to see them moving in sync, correct? So this top example, you can see they're not moving in sync. ES hasn't closed the gap. However, NQ has candle closed the gap. If you are trying to short when ES hasn't closed the gap, you're likely to manipulate it out and hit your stop loss. However, when ES does close the gap and it closes the same gap as NQ, it's a more probable condition that price is likely to go in your intended direction. Another key confluence that we use is momentum. Sounds simple enough, right? However, I see so many traders get this wrong. Let me explain. This is a bearish example, and it's the same for bullish as well. So you can see here that if you see big bearish candles, such as the following, and it's flushing through the gap, this is very strong momentum. You can also see here through the wicks that this is a strong rejection, showing there's a lot of sellers within this area of the market. And you can see here with this momentum, we create a gap and we just flush straight through. We create the gap and we flush and candle close straight through. Now let's have a look at this. This is an example of poor momentum, and this is where I see so many traders go wrong. You can see here that this is very choppy. We're respecting this gap, and then all of a sudden we've had a massive flush through. When this happens, again, it's a strong indication that there's a lot of indecision in the market, meaning that there's a higher chance that you're likely to be manipulated out. We want to trade with the volume, or we want to trade with the momentum. So trading with this is less probable than trading with this. Does that make sense? And finally are going to be deviation levels. So deviation levels look like this. It's actually a Fibonacci tool, and we use these to essentially get where price is likely to react from or likely to target. But this is not just a random guess. We use these through manipulation levels, which again you will see in the trade breakdowns later. We only focus on these levels, which is the -2, -2.5, and -4. You can have a little look on this example here. This is the deviation -2 and deviation -2.5. Prices ended up tapping into this area here. We've then created a divergence, respected this gap, inversed this gap with strong momentum, and we've managed to go short. Deviation levels are very strong confluences that the market is likely to reverse at these specific areas. Will take a little bit of practice, but once you get the hang of it, you can kind of see them with your naked eye. So with that being said, we're going to get into a slight trade breakdown. So this is the Asia sweep model. So as you can see, it's a very simple and adaptable strategy. And the most probable times to trade this are in London session, which for myself in the UK would be 8 till 10 in the morning. As you can see here, the blue circles mark the Asia high and the Asia low, and we'll simply wait for one of these to get swept. As you can see on NQ at the top, we have managed to sweep the Asia high, and on ES, we've also done so. What this shows us is Asia high has been swept, and ES and NQ are moving in sync. These are two confluences added to our trade. Next, we can use our deviation tool from the nearest manipulation leg. We'll simply mark it from the high to the low of the manipulation leg, and this will project our levels. You can see here that when we came into -2, we did have a slight rejection, but the bullish momentum was so strong that we ended up coming up to the -4. So the current confluences that we have, are the Asia sweep, ES and NQ moving in sync, and we've also tapped into our deviation level 4. However, we're not ready to enter a trade yet. So next we need to find our gap. You can see here that on the 3-minute time frame we've created this 3-minute bullish gap, and ES has also formed the same gap. Now we'll look for our divergence, which is very simple. You can see it's a very small divergence, but on NQ we've created a low, and on ES we have created a high. So this is what we call a local div. So the current confluences are shown here. Now again we're going to look for our momentum. As you can see here that we've created this 3-minute gap along with our divergence with the deviation level 4. We've now closed this bullish gap with some strong momentum. And we've also done the same on ES. We wait for the candle closure. Whichever the time frame that the gap is, we wait for that candle to close. So for example, if it's a 5-minute gap, wait for a 5-minute closure. If it's a 1-minute gap, you wait for a 1-minute closure. You can see here that we've closed on the 3-minute time frame on the 3-minute gap. So we simply place our entry on the edge of the gap with the stops just above. As you can see here that we've been tapped into the trade nicely on the next candle, stop loss just above the gap, and we'll simply target a 1 to 2. These are the current confluences, and price is flushed straight down to our take profit. It's really that simple. It may seem like a lot, however, when I go through it with you in the trade breakdowns, I think you'll realize this is so much simpler than you think.
So let's get into a little bit of a trade breakdown to help you understand those confluences a little bit further. For this example, we will use our winning trades, but just for transparency reasons, you can see that we do have losing trades, of course. Every strategy has losing trades. However, you can see my results from this year. So this strategy shows that it does work. So I think this will be a good trade to show. This was the first ever trade that I actually took with this strategy, and I think it will be a good idea to break it down for you, as it will show you some areas where it's common to make mistakes. So as you can see here that we've created this gap, this will have been on a 2-minute, I believe. You can see that we've got our return to entry after tapping into our deviation level 1.5. This is a less probable setup. Ideally, we want to see price come into this area before it validates. I made the mistake of not knowing this. However, it did end up playing out nicely in my favor. We got the return to entry here, and price continued higher. So ideally in this situation, I should have waited for price to come into our deviation 2 to 2.5 to make it a more probable setup. However, if you have a look up here at our deviation level 4, isn't that a bit of a coincidence that we've reacted from that area? No. This happens time and time again. So we ended up framing a short from this area. This was in New York session. We simply had our inverse gap. We candle closed it nicely with some strong momentum, got off the return to entry, and hit a nice, I believe that was a 1 to 2R. You can see here that we've also formed a new manipulation leg, where we've pushed higher to go lower, meaning this is our manipulation leg. We simply mark it from the high to the low, and this will then project our levels. So around 5 months later, I'm much more experienced with this strategy, and I've pretty much got it down to a T. So I'm going to give you a bit more of an in-depth breakdown to help you understand this much better. So let's have a little look at this trade. As you can see, for the confluence for this trade, we had a 15-minute gap respected. We had a divergence where ES took Asia high. We also had a 1-minute inverse gap. As you can see here that this is our divergence. Is this a bullish or bearish divergence? This right here is a bearish divergence. If it's on the highs, it's bearish. If it's on the lows, it's bullish. You can see here that we've created the divergence, so ES would have pushed up higher, and NQ obviously has failed to do so. We've then pushed lower, respecting this 15-minute gap. We've inversed this 1-minute gap with strong momentum. ES would have closed the same gap. We've then got our return to entry, stops just above the high, and we simply targeted a 1 to 2. I'm going to show you this trade first before I actually go through the confluences, in case you want to pause it and actually try see the confluences for yourself. I'll just zoom in here so you can see this specific area, as I want you to understand what this area is. This is the Asia low. This is an important area. This right here is also very important. Hopefully by now you've understood the confluences. If not, it's okay. I'm going to run through it with you now. So this is the Asia low. As you can see, the Asia low has been swept. What we've created is a 3-minute gap, and it was also on the 2-minute as well. You can see here that we started to push up with some very strong momentum. As you can also see, we've created this massive wick and then managed to push up even higher, showing us what? More bullish momentum. We've had a slight retrace, creating a divergence. This is a bullish divergence because it's on the lows. It's only small, but it's still valid. And as you can see here, we've managed to push up with some strong bullish momentum. Quite simply, on the next candle I haven't entered. I've been patient with this entry based on this rejection here, so it's all about being patient.
As you can see, price has pushed up. We've had a slight retrace and then we've ended up pushing up here. After this retrace here, which shows me more bullish momentum, I've then entered the trade on the return to entry. As you can see, we just simply targeted the next recent high. This played out for around 3 hours. Now I'm going to show you 2 charts here, the one on the left being Nasdaq and the one on the left being ES or S&P 500. You can see here that they're moving very similarly. I want you to have a little look up here. We've tapped into our deviation 2 to 2.5 and had a rejection. We've also swept the Asia high. We've created a 1 minute inverse gap, simply closed it with momentum, got off the return to entry, and it's flushed down to our take profit. You can also see here that ES closed the same gap with a lot of bearish momentum based on these rejections up here. We've simply entered on Nasdaq with the return to entry, and it's come down for a nice 1 to 2. Confluences were sweep of Asia high, which we had here. We had the strong momentum, which we had on the rejections on ES, and also the strong flush down the gap. We had them both moving in sync, closed the same gap on ES and NQ, and it tapped into our deviation level 2 to 2.5. Now there was no divergence in this trade, but that's okay. This is what we call a discretionary trade. Discretionary trades don't have to have every single confluence, but because we've seen this time and time again, we understand that if there's momentum behind the move, this is likely to be probable. And finally, for the final trade of this video, this is a very textbook play. So this is what we call a continuation play. The model is the exact same, it's just structured a little bit differently. Rather than getting on a move here, we'll get off on the retracement and the continuation lower. I'm going to show you the trade on screen here. See if you can find the confluences. Okay, hopefully you've had enough time now to have a look at the confluences. I'm going to break it down for you first. So we have the higher time frame gap respected. As you can see here, this is the 5 minute gap, and we are on a 1 minute time frame, so this would be classed as a higher time frame gap. This 5 minute gap here, as you can see, we're starting to see some rejections on the 1 minute. And upon doing so, we've created a divergence. This is a bearish divergence, giving us a strong confluence that the market is going to want to distribute lower. We also have the 1 minute inverse gap that would have also closed on ES. You can see here that we haven't entered here because the gap hasn't been closed, but on this candle, the candle has closed the gap. And this would have been the same on ES. We also had a lot of bearish momentum. You can see here that we had a rejection, tapped into the 1 minute time frame, slight retracement creating the divergence, and then a flush through the gap. What I liked about this trade is there's a very clear target, which is this wick here, which I was anticipating to be swept. We simply got off on the return to entry once this candle closed, and we ended up flushing down to our take profit within 2 minutes. So I hope you've been able to take some value away from this video. I understand there was a lot of information kind of thrown at you, so if you do have any questions whatsoever, please just leave them in the comments and I'll take my time to answer them in as much detail as I can. And if you also are interested to come join myself and the team where we trade live Monday to Friday, you're more than welcome to do so. Feel free to check the link down below. It's completely free to join, by the way. It's a community run by myself, one of my very good friends Chris, and also my mentor Todd, who taught me this strategy, and he's been trading for 11 years. Thank you so much for watching this video. Really appreciate the support on the series so far, and I look forward to catching you in the next one. Take care.